Good morning. You're watching Businessworld Live. I'm Danny Laurel.
And I'm Jess De Los Santos. Here are the biggest stories to kickstart this trading day, Monday. A more optimistic outlook for the economy. Nomura raises its growth forecast for the Philippines this year, but the Japanese investment bank warns about continued risks brought by the pandemic.
Analysts expect the Monetary Board to keep policy rates unchanged at record lows. The local bourse is seen to move sideways ahead of the BSP meeting later this week.
The government hopes to collect higher revenues from POGOs after clearly defining their tax obligations. Taxes collected from the industry hit more than ₱1 billion in the last quarter of 2021.
And tourists flock to Boracay to celebrate the Valentine's weekend. That's as mobility restrictions further ease. We begin our broadcast with a rosier outlook for the Philippine economy this year.
That's as Nomura expects GDP to hit 6.8% in 2022, slightly higher than its previous projection of 6.5%. The Japanese investment bank says the upward revision reflected the faster than expected expansion in the last two quarters of last year. Recall that the economy grew by 5.6% in 2021, reversing the record 9.6% contraction logged in 2020. Now, despite the upward revision, Nomura says their 2022 forecast still falls below the government's target range of 7 to 9%. Nomura notes this reflects their view that low vaccination rates and the risk of a new surge could hinder further reopening and could weigh on growth. Nomura also warns about political instability associated with the impending change in government, as well as a possible ratings downgrade for the Philippines this year. Now, meanwhile, all 16 analysts in a Businessworld poll expect the central bank to keep policy rates steady at a record low of 2%. Analysts believe policy rates will be unchanged to support economic recovery. Some analysts, however, expect the BSP to start raising interest rates in the next 3 to 4 months. This as the economy gains pace and to move in sync with the tightening of global monetary policy. BSP Governor Ben Jokno earlier said that he wanted to see at least 4 quarters of consecutive growth before considering a rate hike. The Monetary Board will hold its regular policy meet on Thursday, February 17. All right, Dan, global markets kicking off the week on the back foot, still reeling over that inflation print over in the U.S. Are we not over it as well?
We are not over it, Jess. Let's take a quick peek at how U.S. markets performed on Friday here, in the U.S. And take a look at that. Nasdaq down by 2.8%. S&P 500 down by 1.9, and even the whole Europe was also in a sell-off. And if you take a look at Asia Pacific, we are definitely seeing quite a cautious open. This as, of course, you've got oil extending a rally, investors now flocking to safe havens. You've also got geopolitical tensions brewing over with Russia's military buildup near Ukraine. The U.S. has warned an invasion may be imminent. And why is this important to global markets? Well, a deterioration of that situation could exacerbate concerns about prices because of the energy disruption that might cause over in Russia. But this comes, like you said, as inflation in January in the U.S. was the biggest annual increase in 40 years, and markets are now speculating that the Fed will be having, quite a hefty rate hike there. This, of course, vis-a-vis our central bank staying dovish. And if you take a look at our peso here, we are at 51.388. RCBC's chief economist Mike Ricafort's main worry here is that this might cause the peso to fall to levels last seen in 2019. And if you take a look at the world currency ranking, we're already at the bottom of emerging Asia's currency ranking. We are the 10th out of 12. This, of course, as BSP Gov Ben Jokno said last month, that the central bank is very comfortable if the peso stays at a range at 48 to 53 to the greenback. Let's take a look at our markets here. Actually, recovering a touch after we fell the most last Friday so far this year. From 7,500 levels, we were back to 7,200 levels. We were the steepest loss in the rest of Asia. This, as Phil Stock says, aggressive U.S. tightening could have a negative impact on the local economy. Investors are, of course, quite worried about capital outflows as well as the weakening of the peso. And finally, very quick peek at our banks here. This, of course, as we are waiting on the BSP's policy meeting on Thursday. The bank's actually up by 0.3% this morning. And finally, quick peek on the property sector. That has not seen the light. That is being sold off, down by 1%, with our biggest property developer, SM Prime, leading the losses, down by 2.4%.
Here are the other headlines we're keeping our eyes on. The BIR collected some 1.22 billion pesos from the POGO industry in the fourth quarter last year, or since the implementation of RA 11590. Now, after clearly defining POGO's tax obligations under this law, the government is now expecting to collect steadily higher revenue from the industry. The law subjects offshore gaming licenses to 5% tax on gross gaming revenue. Foreign individuals employed by a POGO or its service provider must also pay 25% withholding tax on gross income. With the new taxes, the DOF expects collections from POGOs to hit 76.2 billion pesos by next year.
Filipino consumers are now more optimistic, this as the economy continues to recover from the impact of COVID-19. That is according to US-based think tank, the Conference Board. Now, in the fourth quarter of 2021 Global Consumer Confidence Survey, the Philippines ranked 5th among 65 markets examined across the world. The country also ranked 3rd in Asia, only trailing China and India.
The Treasury will sell at least 30 billion pesos worth of 5-year retail Treasury bonds this month. This will be the first retail bond offer by the Treasury this year. The offer period is from February 15 to 26, while settlement is on March 4. The bonds are targeted for small investors who want low-risk, higher-yielding savings instruments backed by the government. Now, after the break, more tourists visit Boracay as restrictions continue to ease.
More of that and other stories when Business World Live returns. Stay with us.
And you're still watching Business World Live here on One News. I'm Jess De Los Santos.
And I'm Dani Laurel. Now, as travel restrictions ease, more tourists are once again visiting Boracay.
And many of them have also opted to celebrate their Valentine's Day weekend on the island. JC Cosico with the details.
Love is truly in the air here in world-famous Boracay Island. Several couples like RJ and Jackie, who just got married last week, decided to spend their Valentine's Day weekend here.
So, ang gusto lang talaga namin makita is yung sand, yung white sand.
Napili namin to kasi, tawag dito, siyempre iba yung beach dito sa Boracay. Then, saka naging madali na rin ngayon, wala na yung mga swab test ganon. So, madali na yung accessibility dito sa Boracay.
And since it's the Love Month, many establishments are offering gimmicks to encourage more customers. At this hotel in Station Zero, couples may enjoy a private dinner by the beach. Tiki and ambient lights were installed to make the vibe more romantic. Families, friends, and those who are single enjoyed this pre-Valentine event at a hotel between stations 1 and 2. Guests also get to enjoy the sky pool with a view of the beach. Valentine decorations, including lights and sounds, will make the experience complete.
Siyempre, di ba ngayon lang lumuwag, medyo bumababa na rin yung cases natin. Kaya naisipan namin magbakasyon kahit paano.
It's the love month once again, so it has been a hard or tough year for all of us. So it's time for us to celebrate the love season.
The Malay LGU expected the influx of tourists in Boracay for the Valentine's Day weekend. Daily tourist arrivals on the island are currently at around 4,000, way higher compared to just 300 to 400 last month. It's because the negative RT-PCR test requirement for fully vaccinated tourists has been waived since February 1. Tourism workers hope the situation will continue to get better so they could recover from their losses. The Malay LGU is expecting the influx of foreign tourists by June amid east travel restrictions. For News 5, JC Cosico, we are One News.
All right, while those scenes in Boracay might be encouraging for the sector, it's still going to be a crawl for tourism activity to go back to pre-pandemic level. Now, an additional pain point, especially for hotels, the scrapping of facility-based quarantine for some travelers. In fact, they're now calling on government for help. To discuss this, we have Benito Bengzon, Executive Director of the Philippine Hotel Owners Association. Good morning, Sir Benito. Thank you for joining us today.
Good morning, Jess, and thank you for having me in your program.
All right, sir. Vaccinated travelers, again, from visa-free countries no longer required to undergo facility-based quarantine. How much of a dent is this going to make on your occupancy rate?
Well, strategically, the opening of our borders to fully vaccinated foreign travelers coming from visa-free countries is a welcome development because in the long term, this will result in stronger demand for our destinations and, of course, for our hotels. Of course, the abrupt shift to regular operations from quarantine operations will have an impact on those hotels that have been relying mainly on the quarantine business. But we see this as temporary, and what it means is that the hotels will have to re-strategize and come up with a better mix of guests.
Okay. What's a particular time frame that you're looking at here in order for you to make that transition, given that for the past 2 years, how much of your total revenue comes from quarantine guests?
Many of well, I will only speak for the members of the Philippine Hotel Owners Association. In Metro Manila, we have about 120 hotels. 84 are operating for quarantine, but we expect some of them or many of them to shift to regular operations. The revenues coming from the quarantine market have obviously provided a lifeline to our hotels. But moving forward, it's now important for the members, our members of FOA, to look at the source markets, so foreign travelers who will be coming to the Philippines. So this is something that, like I said, we'll have to re-strategize, something that will require an evaluation of where the markets or where the tourists will most likely come from in the coming months. But certainly, we see the next 6 to 12 months as very challenging for our hotels as we make that shift from quarantine operations to regular operations.
Okay, like what you mentioned, you're waiting at least 6 to 12 months in order for you to transition to your regular operations pre-pandemic, but you're now, at least at this stage, you're calling for government to provide aid. What exactly do you propose here? Are you looking at a specific amount, and have you at least discussed this with the tourism department?
No, we're not looking at any particular amount right now. The priority at the moment is really taking a look at our operations. And like I said, we have to really identify where the markets will be coming from. We're closely monitoring the movements at the airport. We're happy to note that we're seeing some movements already coming from our long haul and short haul markets. Obviously, this is something that we would like to be sustained in the coming months. The good news also is that the list of visa-free countries where vaccination certificates are now mutually recognized has been expanded. So again, this will hopefully result in a steadier movement of inbound travelers to the country.
Sir Bong, this is Danny here jumping in. Can you give us an idea of how 2021 fared? Perhaps not, compared to pre-pandemic, but just compared to 2020. Was there some form of recovery here? And also, to what extent are you able to already have an outlook or forecast for 2022?
Let me give you the overall picture, the performance of the industry, the hotel industry, ever since the pandemic started. In terms of reduction in revenue, we estimate that revenue has gone about 90% since the start of the pandemic. And this is a huge drop, as you can imagine. We started to see signs of recovery in November when Metro Manila was de-escalated from alert level 3 to alert level 2. We hit a temporary bump, so to speak, towards the latter part of December, early part of January, when we were hit by Omicron. But we're confident that moving forward with the relaxation of travel protocols, we hope to see a stronger demand. As to the timeline for recovery, we think that it will take at least 2 years for the industry to go back to pre-pandemic or 2019 levels.
Okay. Sir, are you generally happy about the fact that the shift will be happening from quarantine hotels back to international travel? Or will this actually, slow down the process of recovery? To what extent are we dependent on recovery from international travel? And to what extent are you optimistic that that will make up for the losses in the required quarantine?
Prior to the decision to lift quarantines, our hotels were operating at about 70 to 80%. We checked with our members over the last few days and asked them for their onward bookings for February and March. And we were informed that they're in the range of about 40 to 50%. So obviously, there's a decrease in the occupancy. But the bigger challenge is really how to get a bigger share of the international inbound traffic.
All right, Sir Bong, very quickly as well, give us an idea. Earlier you mentioned hotels now have to look at specific travel markets which you deem would be your primary source of travelers here. Are there any specific markets you're looking at here? At the same time, are you already seeing increase in bookings for locations? Which locations do you deem would be first to recover?
The first ones to travel to the Philippines will be the balikbayans. That's particularly from North America. So we see a very strong demand coming from Filipino or Phil-Americans coming from the United States. And from the reports that we've received since the lifting or since the decision to allow fully vaccinated travelers to come to the Philippines on February 10, there's been a steady flow of balikbayans. But we're also looking at our traditional source markets. Of course, Korea being the number one market, Japan, China. Of course, there are some factors that will have to be considered, particularly the quarantine requirements when they go back home. We're also seeing some movement already from countries in Europe. So I think the challenge again is to come up with a good mix, determine what would be the markets that will be coming to the Philippines in the next 3 to 6 months.
All right, just the whole industry, of course, still on wait-and-see mode as to what's going to happen as the country opens its borders. Thank you very much for your time this morning. Again, Benito Bingzon, Executive Director of the Philippine Hotel Owners Association. Thank you, Sir Bong.
Thank you, Jess. Thank you, Danny.
The Marcos Duterte tandem is once again leading the latest Pulse Asia pre-election national survey. Former Senator Bongbong Marcos retained his lead after gaining 60%. He is followed by Vice President Leni Robredo with 16%. Senator Manny Pacquiao and Manila Mayor Isko Moreno are tied with 8% each, while Senator Ping Lacson is in the 5th spot at 4%. Meanwhile, Davao City Mayor Sara Duterte Carpio also kept her lead in the vice presidential survey with 50% of the votes. In second place is Senate President Tito Soto at 29%, Senator Kiko Pangilinan with 11% of votes, Dr. Willie Ong with 5%, and Congressman Lito Atienza with 1%. The survey was conducted on January 19 to 24 with 2,400 respondents. Now, Capital Economics says the Philippine economy would worsen under another Marcos presidency. The London-based think tank said in a report that several key factors have contributed to the underperformance of the local economy over the recent decades. Those factors include poor governance, an undermining of institutions, as well as corruption and nepotism, among others. The foreign think tank said that the situation could easily get worse under a Marcos Jr. administration, the Philippine Star reports. Capital Economics noted that Marcos Jr. has not laid any plans on fiscal policy, how to improve the business environment in the country, and even how he would help the economy recover from the pandemic. They also noted Marcos Jr.'s, quote, poor legislative track record and involvement in corruption allegations. The report of Capital Economics was issued Friday last week ahead of the Pulse Asia survey that showed Marcos Jr.'s continued dominance in pre-election surveys. And that's a first look into the business day this Monday, February 14, 2022. I'm Jess De Los Santos.
And I'm Danny Laurel. Happy Valentine's Day. Mask on, wash hands, stay safe, Philippines. We are One News.